What's up? Hope you guys are doing well. So today we're going to talk about 3 different templates you can use to start out for managing your risk. So first off, why have a go-to template? So oftentimes people think about how much they can make, but not enough about how much they can lose. So they usually guesstimate their position sizing in trading, and it's very random. On top of that, people often move their stop losses, or they don't even have any stop losses. So if you're guessing how much you're going to put in a trade, you don't know how much you're going to lose. And even when your idea doesn't work, it hits below your stop loss and you move that stop loss, or you don't even have stop loss and you blow up your account, this creates a very bad recipe for success long term, which you'll probably lose, as the majority of people do in trading. So let's get into the first one. The first template is the optimal trade. So this is like the best of the best opportunities for you, whether that be scalping, swinging, etc. So for these next several trades, I'll be doing swing examples. So the risk to reward ratio is really good for you. So for example, maybe like a 4-to-1 reward risk ratio, or something extremely high. It could be even more. So the thing about this one is where you'll use the most risk, as it has the highest probability to win and has high reward potential. However, it has a high risk factor, as you'll be risking 2% of your account. So think about this, is that not only do the short-term time frames match, like the 30-minute, 1 hour, but the longer-term time frames match. So ideally, at minimum 4 hour, but optimally daily, weekly, monthly too. And maybe this opportunity comes every 2 to 4 weeks, every 1 to 3 months or something. For example, if Bitcoin randomly got dumped right now 25% or something, then that would be a great opportunity to go long as the fundamentals are still the same. So you see in this picture, it got beaten down from 64K to 47K, which creates a great opportunity. And then ideally there would be a good pattern, like a double bottom or something. However, this works as 47K is a very strong support area in which it would most likely bounce up. So you wait for that first heavy green candle right here, which after you reverse in that red momentum going down. So then that would be a great starter entry point for this optimal trade. Okay, next one is the great trade. So this is a rewards risk ratio of at least 2:1, or for you it could be different, where it's not as big as that optimal trade, but it's still a good trade to take. In this case, you risk 1% of your account. This is due to it not being as good, as the likelihood of the trade not working out is higher, so you risk less. And optimally, it's validated on medium-term time frames. So maybe it's not validated on a daily or weekly, but maybe it's good on a 4 hour and 1 hour too. And ideally, there'll be a clear pattern, like a channel, inverse head and shoulders or something. So it's most likely to succeed, but maybe it's not the best opportunity. So maybe these opportunities for swings pop up like every 1 to 3, 7 days-ish. So what we do want to do is to figure out when these opportunities pop up, as maybe you might be thinking, oh, this great trade pops up like 5 times a day, which most people do as they overtrade. However, maybe you look in the past and then you backtest stuff, you realize that the actual great trade, maybe it pops up like every 1 to 3 days instead of 2-3 times a day as you thought before. So example, in this one, Bitcoin forms a little channel where its support is tested 3 times right here. So maybe the 3rd time right here, you could go long. And maybe in the second one too, if it bounces down here, barely touches it, goes up, that's a very strong case, and it has a higher high, you could input a little bit there too. The last template is called the risky trade. So this is a trade where there are a lot of very conflicting information, and maybe it's not the most optimal trade. However, it has the highest or has a really high reward potential of ultimately at least 3 to 1. And for these, since it's so risky, it's more beneficial to use less of your account, so 0.5% of your account risk. So usually these are validated on shorter time frames. Let's say, for example, Elon tweets something, he's like, oh, I hate Bitcoin, which literally happened a few days ago. Then it shoots down like 10-15%. And if you're lucky, maybe you caught the bottom of that wick. So instead of going all in your accounts, as maybe someone big sees that tweet and then they decide to dump their things, and then it goes down an additional 10%. If you used up all of your accounts, you'll probably get destroyed from that trade, or you'll miss that opportunity to get an even bigger deal. So you can use these on big opportunities like an extreme dump, you go long at the bottom, or even as a hedge, right? So let's say things are looking very bearish. So for example, this past week on the daily chart, Bitcoin formed a lower low, so a lower high. So it went from 64K to 59K. While Ethereum, even though it's outperforming Bitcoin right now, it is abnormally higher than the other assets. So on the daily chart, the RSI was like around 90, which indicates that there will be a sell-off soon, and the sell-off did happen. It went from 4,400 to around 3,600, like around a 20% correction. So if you're able to identify that, and then yes, there's a chance that Ethereum could have went higher. It could have easily went to 5K. However, that risk reward potential where if Ethereum corrects 20-30%, and then you get maybe 1 out of 3 of these hedge positions good, then you'll probably make that all back and some more. So a big important thing, last thing, is to minimize your total risk at any given time. So for that would be ideally 3% or even 2%, whatever your risk tolerance is. So my risk tolerance is a little bit higher, so I prefer 3%, but depends on you. So for example, one optimal trade at 2%, one great trade 1%, 3 great trades 1% each, or one optimal, 2 risky trades. So why would we do this? So if you know how much you're willing to lose at any time, it's very hard for you to blow up your account, right? So a big reason why most beginners fail in crypto or stocks, etc., is that they over leverage their position. They go all in on options, all in on 10, 15, 20x, etc. However, there's that one law, right, where anything that can happen will happen eventually. So if you get lucky, you 5x your account, but then all it takes is one bad trade to just lose all of your accounts. So you have to be ready for that one scenario that will happen in the future, which is shown by this quote. It's not about how much money you make, but how much you can keep. And then from these riskier trading methods, you take those profits, you input them to longer term safe assets that will accumulate and grow for you without you actively doing it. So hope these 3 templates help. Feel free to adjust them for whatever trading style you use. I'm more of a swing trader who trades on the hourly, 4-hourly charts. So maybe for you, you might be a really good scalper, so maybe bring it down for that. Or maybe you might be a better investor. So figure out what works for you and you'll be good.